Picture money not as a stack of bills or digits on a screen, but as a flowing river, restless, relentless, always moving. While most people try to scoop from it with a small cup, only to end up drowning in credit cards, car loans, and student debt, the ultra-wealthy step into that same current with engines and pipelines. They don't fear debt. They study it, price it, and turn it into a tireless worker that builds wealth around the clock. Used poorly, debt sinks households into chaos. Used wisely, it multiplies time, energy, and capital so powerfully that decades of hard labor can be compressed into just a few focused years. And the difference lies in strategy. Instead of borrowing money, the wealthy borrow products. A pen wholesaler needing to ship containers from Shenzhen to Chicago doesn't wire $100,000 up front. He builds trust with the factory, secures 60-day terms, and receives the pens without touching his capital. By the time payment is due, the goods have already been sold. The same money turns over multiple times in a single quarter. This system, called trade credit, powers everything from Amazon vendors to supermarkets and car dealerships. It frees the entrepreneur's money to grow the business, while someone else supplies the goods. Others use real estate as a machine. Imagine buying a neglected duplex for $500,000. With a modest renovation, its value jumps to $700,000. A refinance at 80% of that new value unlocks $560,000, enough to repay the original loan and renovation costs and still pocket $110,000 tax-free. Rent pays the new mortgage, while the investor keeps the building and recycles equity into the next project. This BRRR method, buy, rehab, rent, refinance, is how professionals turn time and sweat into compounding returns. The trick is to push value up fast, then lock in low-cost, long-term debt that keeps the capital moving. Borrowed money also supercharges businesses. A profitable online cosmetics brand, instead of growing slowly, can issue low-interest bonds, hire more staff, increase advertising, and produce at scale, cutting unit costs and multiplying revenue. If returns outpace interest, cash flow explodes. This isn't theory. Giants like Apple and Nestlé borrow billions despite sitting on mountains of cash. The math works. Even dentists and software founders use debt to open second locations or acquire new users. The pattern is clear. Borrow at 4%, earn at 12%, and reinvest the difference until competitors can't keep up. In the markets, debt becomes a bet. Leverage amplifies every move, both up and down. A 10% stock gain with margin can double your investment. A 10% drop can wipe it out. Sophisticated funds go further, short-selling shares they don't own, profiting when prices fall. It's risky, but not reckless, because every decision is backed by data, strategy, and balance. The point isn't to copy hedge funds, but to understand this. Debt is a volume knob. It intensifies every outcome, so it must be used with precision and purpose. Some take it further, living off debt entirely. Wealthy individuals build portfolios of appreciating assets, real estate, stocks, private companies, and then borrow against them to fund their lifestyles. Since loans are an income, there's no tax bill. When they die, U.S. law resets the asset's cost basis to current market value, wiping out decades of capital gains. Heirs pay off the loan and inherit the rest, tax-free. This buy, borrow, die strategy is a legal, powerful use of the system, turning tax law, inflation, and time into allies. Even housing follows this logic. Mark Zuckerberg took out a 1% mortgage despite having the cash to buy his home outright. Why? Because every dollar tied up in bricks is a dollar that can't earn more elsewhere. If your investments grow faster than your mortgage rate, the math favors borrowing. Entrepreneurs free up millions by financing homes and reinvesting in ventures with higher returns. Even average families can apply the principle. If the loan is fixed, the payments are affordable, and the discipline is there to invest the difference. Debt, then, isn't good or bad. It's a lever. And like all levers, its effect depends on the direction you pull. The wealthy treat every loan as a business deal. They measure cash flow before signing, insure against risk, and exit when conditions change. They know that borrowing in a depreciating currency to buy appreciating assets flips inflation from threat to advantage. When debt puts money in your pocket, you're in control. When it drains you, you're enslaved. In the river of money, the careless get swept away. But those who understand the current build engines that take them farther, faster, with less effort. Thanks for watching InvestingFlix, where smart money learns smarter moves. Subscribe for more insights that grow your wealth.